You are listening to chartingwealth.com for Thursday, the 24th of May, 2018. Thank you all again for purchasing our book, Charting Your Way to Wealth. If you want to know what it is we do here at chartingwealth.com, you want to have everything explained to you from the derivative oscillator to the price percent oscillator to the type of Heikin-Ashi candlesticks we use to all of the indicators, the minor ones, the major ones, our two primary ways of actually charting and purchasing and selling. We've got it all there for you in the book, and I really encourage you to get it. It will help supercharge your training and help put you on your way to becoming a charting master. Now, something I want to show you guys, a little sneak preview. We're not there yet. This is our quarterly chart, and many of you have taken our quarterly chart training that we put out every quarter. When we look back in time, okay, on our charts, we go back about 20 years. Our charts don't go further back than that, and this is just the charting software that we use, but we go back as far as the year 2000, actually go a little beyond that, but where our first vertical crossover going down occurs. That is in September of 2000, of the year 2000. What did we see happen? We had the markets turn and start heading down, exactly in line, very, very close in line to what we saw when we had a quarterly, I almost said weekly, quarterly vertical crossover going down. If you would have gotten out of the market then, you could have ridden the market, you could have watched the market go down. You could have, in fact, even taken an inverse position. You could have shorted the market, but again, to short it that long term, very hard to do just the way that the inverse ETFs work. But regardless, you could have gotten out of the market, you could have let it drop, and then you could have bought back in when the market turned around and started surging up there in the beginning of 2005, and you could have ridden it up until it started moving down in 2008, about mid-year. You could have let it drop and bottom out, and then you would have gotten back into the market, according to this chart, there in about, around March or April of 2011, and ridden it up to its peak prior to the Trump effect that we've also talked about many times. The only time this has ever happened, about the time that Donald Trump jumps into the presidential race and the market realizes what's coming and starts flying up. But here's what I wanted to show you. Now, we won't have our next training until this candle closes at the end of June, but it's very interesting. It is a pullback, and we're seeing it already on the quarterly chart. We're seeing flat price movement, and we're seeing a red open box candle. Not good. We're seeing the derivative oscillator is actually, so far, it's losing momentum, and the price percent oscillator is going pretty flat. So again, just a little warning. If you're into your training on long-term investing, something you really, really want to work in. These purple lines on our charts show the quarterly vertical crossover going up, which occurred back in 2017. That again was in the March-April timeframe. And of course, we've had consistent quarters of up movement, but this latest quarter is giving us a little concern about what's going to be happening in the long term. So just beware. We're already seeing that on the quarterly chart. At the end of June, we'll tell you about the quarterly training when we get ready to put it out. But that is just an aside for those of you who are concerned about where things are going. That pullback is a little bit disconcerting. Okay, let's talk about where things are. Everything up for the day. The S&P 500 up 0.28%. We again see an up-moving set of candlesticks going into the third week of up movement. Again, we're just through the third day of a 5-day candle. We don't have a confirmed crossover yet, and we won't until the end of the week. If that happens, if there's some pullbacks, it won't happen. Derivative oscillator has gone positive. Price percent oscillator looks like it's getting close to crossing over, going up. If that occurs, of course, it'll be a weekly vertical crossover. We'll let you know, and then the rules will be in effect to do a virtual trade, a virtual purchase going in the up direction on the S&P 500 at about 10:30 a.m. on Monday morning after idiot hour is over. We'll tell you more about that if it occurs. We see on the 2-day chart, of course, it rotated over going up back on the 16th of April. went up for 2 more days and then down for a while, then started moving up again on the 8th. Still seeing a good bit of sideways sliding. This latest 2-day candle is actually a doji. Now, we had the prior 2-day candle ending on Tuesday. This is just the first day of the latest. So again, means indecision. We've breached the 2-day trend line no matter how we might try to draw it. So again, bit of a pullback we're seeing there. And we look at the derivative oscillator, pretty much flat. Price percent oscillator, however, is still heading up. As we look at the 4-hour chart, what do we see? It, of course, is flat, still in a confirmed down move. We saw down movement in the morning. Bit of up movement in the afternoon, just ended up being a doji, means indecision. Derivative oscillator gaining downward momentum, like we said, price percent oscillator flat. So until we have a weekly vertical crossover in the weekly chart and the 2-day are moving in the same direction, we don't have a trade on the S&P. We'll continue to watch and monitor it and see if we do have some more up movement by the end of the week. Going to the Qs now, that's the NASDAQ 100. When we go to the weekly chart, which is where we always start, go from the big chart to the smaller chart, what we see there is not a green up candle, but a red open box candle. Again, doesn't mean strong down move like a solid red candle, but it does mean a pause and a bit of a pullback. Derivative oscillators gaining momentum, price percent oscillators sitting right there on the red signal line. And of course, the 2-day chart is continuing to go sideways, which it has been since the 2-day candle ending on Wednesday the 16th, so a week ago, just pretty much sliding sideways. First day of this latest 2-day candle, even though the Qs was up 0.84%, our Heiken Ashi candlestick, which shows the average pace of price movement, is a doji, so showing lots of indecision tending down. Price percent oscillators going up. Derivative oscillator, however, is losing energy. Again, we like our oscillators to be moving in the same directions. When they're not, it of course means what? We have sideways sliding, and if you don't have oscillation, oscillators don't work very well, which means sideways slides in the market don't work well with oscillators and being able to recognize price movement. We need trending markets. So let's go from the 2-day to the 4-hour. And we see on the 4-hour chart down movement in the morning, up movement in the afternoon. Derivative oscillators losing downward momentum. Price percent oscillators headed up. So we'll wait and see. Again, same thing on the Qs as we see on the S&P. We basically have the weekly in a confirmed down move and the 2-day in an up move. Until and unless the weekly crosses over going up, our rules don't allow us to actually have schizophrenia between the two, our medium chart, the 2-day chart, and the large chart, the weekly, because we're trend following. We want everything to be moving in the right direction, either up or down. If it's down, of course, we're looking to trade an inverse fund or to buy a put. And that, again, is a little more advanced. If those of you who are just learning to practice, just get out and chart how accurate you are in calling a down move. There'll be plenty of time to learn about how to make money when you get good at reading the charts. Too many people convince themselves they are charting masters and then start trying to use real money. That's why we're saying it may take you a while to get the hang of this. If it were easy, everybody could do it. If it were simply a mathematical thing, then the engineers would be calling the show, and they're not. It is literally a chart thing, and it is a practice thing, and it's learning these markets by doing. Every day, 10 minutes, that's all we ask. Okay, back to the weekly chart and to 20-year bonds. What do we see going on there? Of course, they crossed over going down on the weekly vertical crossover at the end of the prior week, and we're into our second week. Well, we're into our first week after the weekly vertical crossover. Derivative oscillators gaining downward momentum. Price percent oscillator is flat. As we look at the 2-day chart, what do we see? Well, the derivative oscillators losing momentum. The first day of this latest candle is actually an up candle. And again, we're in a confirmed down move on both the 2-day and the weekly. So then how do we decide when and if to enter things? Well, that's indeed if our 4-hour chart's moving in the right direction, and it has not been. It, in fact, was moving up at the beginning of the week. So we watched things cross over going up. If indeed it rotates over going down, crossing through what we call a 4-hour vertical crossover, we can see when that happened back on the 15th. We need something like that to occur in order to get us into a down move. That's why we held off and did not make any kind of commitment, because when the market opened on Monday, it was moving up and we saw a crossover going up and did not have a jumping in point. At this point, we may, if we do, we'll get in. If not, we'll just stay safe and watch things until we get something set up that works and goes in the right direction. That's where we are on 20-year bonds at this point, waiting for that pullback to end, if indeed it does. Okay, lastly, on the weekly chart, we go to gold. Gold is up 0.11% for the day. Now remember, gold started moving down strongly. It's been in a confirmed down move since all the way back in mid-March. And we see that starting on the 27th of April, gold started moving down quite strongly. And so far this week, the Heikin-Ashi weekly candlestick is down. Strong derivative oscillator heading down. Price percent oscillator going down on that weekly chart. Excuse me. On the 2-day chart, we see things really flattening out around that 122.30 mark or so, 122.15, 30, something like that, but right around the 122 mark. And we see first day of this latest 2-day candle is a green up candle, a small one, albeit a spinning top, means some indecision tending up. Derivative oscillators losing downward momentum. Price percent oscillators not heading down at the same angle, still heading down. But again, as we go to the 4-hour chart, you'll really see what we've been talking about, and that is where things have really flattened out in gold right around 122.20 and just slid sideways. We saw some down movement in the morning on gold in the Heikin-Ashi candlesticks, a green spinning top in the afternoon. But with that price movement, particularly in the afternoon on Monday and the morning on Tuesday, that was enough to start a 4-hour vertical crossover on the price percent oscillator, and the derivative oscillator has been gaining energy since then. So again, if you jumped into that move just when we had the crossover going down back on the 15th, again, pay attention. Gold may not continue to trend up. It may cross back over and move down, but don't lose the little bit that you gained. You don't need to stay in if indeed it does not end up working out. Doesn't always. Like we say, this is the hardest, the roughest time of year to trade, but that's exactly why you should be practicing. You should practice every day, because when we get into the fat time of year in the fall-winter trading zone, it'll be so much easier for you to see trends, to be able to jump in and do successful virtual trades. It's all about practicing. And practicing in the toughest times when everybody doesn't want to practice makes it even more valuable. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.